Right. Good evening and welcome everybody, and thank you for taking the time to hear me out here. I'm going to be speaking for about 45 minutes or so, depending on questions. I'm going to be covering, as the heading says, 2023, see what the markets did and see what lessons we can learn from that. A little bit about 2024 views, and I'm going to be covering Israel specifically for obvious reasons. This is actually our fourth webinar stroke presentation this month. We've hosted two in Hebrew, one a similar subject matter to this, one specifically on alternatives. We also hosted the ex-head of the Bank of Israel, Professor Carney Flug. We hosted her in our offices, and her presentation, it was in English, and it was recorded, and I believe it's available on our website as well. So when I talk about Israel, most of what I say is from that presentation with Professor Flug. So you can take that there was pretty strong credentials on that side. Okay, let's kick off and get into things. Oh, by the way, this is recorded, obviously, and you can post a question at any time using the Q&A function. Right, let's kick off. Oops. Okay, so a snapshot at 2023. It was a very strong year in markets. You'll see in a second when I show you the indices. You've probably seen your report and you're reasonably satisfied, I would hope, with very strong returns. Equity market, mainly the US, was super strong despite the recession fears, despite higher interest rates. In fact, if you go back a year, no one predicted, I don't believe anyone predicted how strong the equity markets would be in 2023. I'll talk about exactly why we think that happened in a sec, but let's just summarize what happened. There was a meaningful amount of interest rate volatility, which affects the bond side of our portfolios. Not as volatile as 2022, but more than normal, right? So our reference point for the bond market is the US Treasury, the US government 10-year bond. That's our reference number. And that one, the yields started at 3.7 at the beginning of 2023 and ended at 3.8. So from an interest rate point of view, looking at the year as a whole, there was very little volatility there. But during the year, we hit 5% on the 10-year. Now that's a very 1% and 30 basis points is a very significant move in 12 months on that instrument. In 2022, which, if you remember, those of you who were on my webinar a year ago, 2022 was absolutely exceptional. Now, when interest rates, just to remind you all, the Federal Reserve sets the short end of the interest rates, the overnight interest rate between financial institutions, and the market sets the rest of the interest rates. So when there's a demand for bonds and people are buying bonds, the price of bonds goes up and the yield goes down, and vice versa as well. In 2022, interest rates went crazy. Ukraine, we had post-COVID inflation, et cetera, and we had significant losses on in the bond market, okay? So 2023 still had a high level of interest rate volatility, but nowhere as bad as 2022. The big story, I guess, is inflation coming down. Headline inflation, the various measures of inflation, I'll talk about it, I've got a slide on that, but we've got headline inflation coming down from the beginning of the year, 6.4, it was actually 8% in 2022, to the end of the year, the headline inflation was 3.2. So that's a significant achievement, and Fed policy, monetary policy is working to bring inflation down, and it's been, so far, relatively painless, okay? So the soft landing scenario is the base case, and it seems to be working for now, okay? As you are very well aware, geopolitical risk is on the rise, but the markets seem to be shrugging that off completely. Here are a summary of the main indices for 2023. These are the main markets that we invest in. And then I've put next to it the last 36 months, just to put it in context, okay? So we've got S&P 500. Those are the 500 largest companies in America. That equity index made 27%. Okay, a very, very, very strong year in US equities. The last 3 years, so if you include 2022 losses, then you've made 33%. Now that's an annual return over the last 3 years of just under 11%. That's a fantastic result. It's a little bit higher than what we'd normally expect from equities, but we've become used to sort of 9, 10, 11% on the S&P 500 over the long term, but never in straight lines. And I'll talk about that in a bit. NASDAQ, extremely strong, plus 56%. I'm very happy to say we held both the S&P 500 and the NASDAQ in our global portfolios, just the plain ETFs. Nothing wrong with that, and they perform beautifully. Last 3 years on NASDAQ, only 34%. So quite similar to the S&P 500, not fully reflecting the additional volatility that comes with NASDAQ over S&P, but not a bad result at all. MSCI World, that's all the countries in the world. It's 55% US, and the rest of the world makes up the balance. And that did 23% last year and 20% over the last 3 years. The rest of the world did well, but not nearly as well as the US. Okay, last year, and I guess that's true for a longer term as well. Tel Aviv finished the year positive. This is in shekels, 3.5%. And it's made 19%. So Israel's over the last 3 years is similar to the rest of the world. And I would say that the finishing the year positive after what happened in the fourth quarter is a good result. So shows some of the strength there. China, I'm going to speak specifically about China. China made 13, the broad MSCI index on China made 13%, but if you were in it the last 3 years, then you are crying at minus 45%. Not fun. I'll talk about China in a bit. Global bonds, this is the Barclays Global Aggregate Bond Index, the main bond index. It has a longer duration than what we would have in our portfolios, but it did a very reasonable, I would say actually an excellent 5.7%. Remember, bonds, you don't expect double-digit returns from bonds. But if you look at the last 3 years, you'll see that it's still in negative territory, minus 15%. Now, this is still the hangover from 2022 that has affected many, many conservative investors. The exact same bond that we buy today, where we can get 5.5% on that bond, that exact same company 4 years ago was giving us, or 3.5 years ago was giving us 1%. So conservative investors were extremely frustrated that the bond component was giving them so little. And then 2022 came, inflation, and they experienced losses there. So very, very exceptional events in 2022, which are still hanging over investors' heads. Treasury bonds, this is an ETF that are used on an index, and it's a similar story, right? You made less money in 2023, still suffering the damage from 2022. Gold, we don't hold gold in our portfolios. It's too much volatility, too difficult to predict. But if you held it in 2023, you made just shy of 12%. If you've held it for the last 3 years, then it's 7%, and that's 2 point something per year. That's not great for the volatility that gold introduces. Using gold as a hedge is a debatable point. I've discussed it in webinars in the past. I don't believe that gold is the hedge that people historically have used gold for. It's too volatile and too difficult to predict, so we don't use it. Then Israeli corporate bonds had a decent year as well. Similar story with interest rates came down a bit in Israel towards the end of the year. And the longer term story in Israel bonds is a lot better than global bonds. Right. Why were equities so strong? It's worth looking at this and seeing what lessons we can learn. So 2022 was oversold. There was the pessimism that there's a recession coming. So we knew we had very high interest rates in 2022, which came very suddenly, and it was a surprise. So people were expecting bad news, and that bad news never happened. So one, it was oversold. Two, the bad news that was expected never happened in 2023. That's reason number one. And the anticipated recession and slowdown in growth didn't happen either, right? If you read any of the material from 15 months ago, they all were predicting some sort of slowdown in growth or a recession, and this never happened. We actually had decent growth out of the US economy. Then there's the artificial intelligence story. That's definitely part of the optimism in the market. The company that's leading that is NVIDIA, which is in all the indices. It's in the S&P, it's in the NASDAQ that we own. I think that this story still has a way to go. It's still got a lot of hype that can be delivered. It's one of those stories where we could easily get into bubble territory because it's not very well understood. It's a fundamental change to the world of computing. And it could be one of the drivers of some positive returns going forward, but we'll need to watch it. We'll need to watch it because it's one of those themes that can easily become overcooked. Another interesting point I want to make is this concept of injecting of liquidity. Now, for many years, the dinner table discussion was the Federal Reserve is printing money, and that's why the stock market is done so well, right? That was a sort of repeated theme at dinner parties for many years post 2008. But it's wrong, right? First of all, the Federal Reserve, when they do their quantitative easing, right, when they buy bonds, they're injecting liquidity into the bond market, not the stock market. Now, there might be a trickle-down effect, and creating stability in the bond market can help the stock market indirectly, but certainly not directly. And also, I've always taken exception to this phrase, printing money. The buying of bonds as part of a monetary policy easing program is not printing money. It's putting money in the system, but not printing money. So it's not the same as a Zimbabwe situation. Okay, so I object to that. But interestingly, in summer of 2022, the Federal Reserve began contracting their balance sheet quite significantly. I think the numbers are something like 9 trillion down to 7 trillion, right? Just in 2023, the Federal Reserve reduced their balance sheet by about $800 billion. So that is liquidity being withdrawn from the market, from the bond market. The trickle-down effect is on the stock market, but that is liquidity withdrawn, which is the opposite of all that dinner table discussion, which I'm sure you all heard. All right. So the stock market ran very, very strong in 2023, despite the Federal Reserve withdrawing that liquidity from the market. So that kind of indicates to me that a lot of the things which sound intelligent are actually nonsense. And just bear that in mind. So the lessons from 2023, and I think it's very important to remember all of this, is you need patience. When it comes to equity investing, it does not work in straight lines. You're going to have negative years, you're going to have positive years. You need to understand that accept the risk in there. And more so, you can't time it. You've heard the cliche, it's not about timing the market, it's about time in the market. Just on 2023, we saw some very chunky months, November and December. If you were not in the market in Q4, all right, if you would have sold your investments when the war started or something like that, you would have missed out on a significant part. So the returns are not in straight lines. They can be very chunky. And this is an important lesson. So you really need to think long term. Those of you who've seen my webinars before know that I always use this slide. It's my favorite slide. S&P 500. The blue line is including the dividend being reinvested. You can see, just forget the scale, the numbers. You can see how powerful that dividend reinvested over time. This is 1995 to 2003. So you're taking a proper step back, and you can see the three major crises. There were another 20 minor crises, but the major crises, .com, 2008 financial crisis, and COVID, they're all in there. Yes, it went down, but so what? I believe very strongly that the S&P 500 needs to be in every portfolio. In the news the last few days, you might have seen a headline saying something like S&P breaks its record, highest level ever of the S&P. This doesn't mean that S&P is expensive, all right? It's just an index and it's at the highest level ever. So this white line that you see on the screen here, the bottom line, that is the price index. And you can see that it's broken through its record thousands of times. It went in 1995, it was about 800, and now it's 4,800. So it's broken. So looking at that headline should not influence your decision to invest in the S&P. It's the same rules. S&P 500 is an equity. Equities can go down the day after you buy them. You need to know that before you buy it, and then you buy it for the long term and forget about it. Okay. So that's one of my favorite slides. Okay. Now, I mentioned this before, 2022 is still a hangover over longer term performance. In preparation for this webinar, I looked at my presentation from a year ago, from January, and I put in a slide there where I compared a investment grade bond to a bank fixed deposit. In 2023, our biggest competition was bank fixed deposits. At the beginning of the banks in Israel were offering 5%, then it came 5.5%, and we even heard of 6% on a fixed deposit. So clients who looked at their 2022 results, okay, in their portfolio, and they said, well, what do I need this headache for? And some of them put some money in, or their portfolio money into a bank fixed deposit. And they were very happy with the 5 to 6% that the bank was offering, okay? Because there's no risk, almost no risk, and no headache, no fees, no stories, nothing, very simple. But that's an investment decision being made by looking in the rearview mirror. It's not forward looking. You're looking backwards at 2022 and you're making an investment decision which affects 2023. If you would have stayed in a balanced portfolio, right? Any portfolio that has 30, 40, 50% of global equities, you would have made 2.5 to 3.5 times that 5 to 6%. It's very reasonable in 2023 to have double-digit returns, anything from, I don't know, 12 to 16%, depending on your portfolio. So you can see it would have been much better to have a balanced portfolio in 2023 compared to a fixed deposit. And that's another takeaway lesson. Don't make investment decisions by looking in the rearview mirror. One has to take a view about the future. Okay, so in my presentation last year, I said that we expect stocks to rebound relatively quickly. I didn't expect them to bounce back as quickly as they did, but we knew that stocks would bounce back relatively quickly. And we also knew that bonds would take longer, and which they are. So we've collected our coupons and we've got our yield for 2023 in bonds. It's going to take a while still, 2, 3, maybe 4 more years to recover from that very exceptional 2022. Here I've explained how significant that transition is. We went from a low in the peak of Corona in June 2020. Remember that reference line that I said, the US government 10-year treasury bond? That's all bond prices are set relative to that, okay? So that in June 2020, that was giving you 0.5% per year for the 10 years going forward. And we hit 5% in October. So that's a very, very, very significant move. To expect the same type of thing from where we're at now, say 4 to go to 9, that's not going to happen, okay? I'm reasonably confident that we're not going to see 9% in the US Treasury. So the point is that I think a lot of the bond pain is behind us, and we can look forward to relative stability in the bond market and collect our coupons. And this really helps your average private client investor who's going to hold some bonds. So that makes me a little bit more optimistic about the future. We come from a world, as I said, we were buying bonds, we were getting 1%. It's not enough money. Now we can buy that same bond getting 5.5%, no problem. Okay, inflation, right? So this is a big part of the 2022-2023 story. Inflation peaked. There are many measures of inflation, but I'm talking about headline inflation, the one you read about in the newspaper. So it peaked at 8% in 2022, and it went to 3% at the end of 2023. Maybe that was the easy part, all right? We still have to go down to the Federal Reserve's target, which is a long-term average, not a one-point number, of 2%. So that means inflation needs to come down another percent. Maybe it's going to be more difficult. Maybe, I don't know. But if it does not happen, if it happens as it's expected, then we expect the Federal Reserve already said they will lower interest rates. But if it gets a little bit sticky, all right, and we may even have 1 or 2 months where inflation ticks up, all right, and if it's too slow, then what we can expect is that interest rates will remain higher for longer, okay? And then this is going to bite into the economy via the debt financing. The US government has just got too much debt, 30 trillion or some crazy number, and they have to service that. And if they have to service that with higher interest rates, it's a huge number. So maybe inflation won't come down so quickly. I don't know, but it still has a little way to go till we have this COVID inflation behind us. Right, that's my 2023 summary. We're now looking a bit more at 2024. All right, why? I've got here reasons for stock market optimism and reasons for stock market caution, okay? It's an election year, not just in the US, but in quite a few major countries. Historically, election years have been positive for equities. Typically closer to the election, not necessarily, not all the years have had good first quarters, but typically from Q2, election years have been good for the market. Why is that? Because the politicians don't want to upset the market, so they don't announce any crazy policies that the market won't like. There's a technical support. Okay, technical support is just pure number crunching without any backstory. The Bank of America research report I saw the other day that said if there's a positive year which follows a negative year, then the third year is positive. So they took 20, 25 times over the last 100 years where you've had a negative year followed by a positive year, and then the third year was positive 86% of the time. So, and basically what they're saying is it's highly likely that you get 2 positive years after a negative year. It's pure technical analysis. It ignores the backstory. I'm not a huge fan of technical analysis, but it sometimes gives you a little bit of comfort. I think more important than technical analysis, economic growth in the US is still strong, stronger than anyone thought it would be. That doesn't mean that it's immune. You know, it can still have problems, but it is a really, really, really strong economy. Now, why should we perhaps be cautious? Inflation could be sticky, as I explained in the previous slide. It may not come down to 2% so quickly. Interest rates may stay high longer, and there'll be consequences to that. There may also be some some famous company or that is restructured or Chapter 11 bankruptcy because it's over-levered. Right? That could happen too. Recession fears still exist. The probability of recession is much lower than it was a year ago, but it's still there. It's not zero, okay? Goldman Sachs, I think, said that there's a 20% chance of recession, and a year ago they were saying something like 40% chance. So clearly less chance of recession, but it could still happen. And by the way, recession is not something which should influence equity investing, okay? When you buy equities, as I said, you buy them, you forget about them, and you make sure you're diversified, broad market risk, and don't worry about recessions. Then, of course, geopolitical risks. I don't have to expand on this too much. You all read the newspapers. The world feels scarier than it has for a long time. You know, Middle East, Ukraine, China, Taiwan. The way I can succinctly summarize it, as I see it, if the trouble areas remain Ukraine, Russia, Iran, Israel, Iran or its satellites, and Israel, the market will brush it off. If it becomes more of a NATO versus Russia thing in Europe, or if China decides to do something militarily against Taiwan, that's a whole new level problem. And that's not, I put that as a low probability, and therefore we haven't done anything in our portfolio for that event. If that happens, then we'll have to see, we'll have to address it, because those would be obviously very, very significant events, and we'll have to deal with that if it happens. Okay, China. Right, those of you who've watched some of my webinars over the last few years, you'll know that there was a time where I was pro-China. Now, we knew China has risks. It's not that it doesn't have risks. So we did have a very small allocation to China in our portfolios. We've sold that since then, and it didn't work out for us. The logic at the time wasn't so much about the Chinese economy. It was the size of the stock market that was what was driving me. If you take the Shanghai stock market and the Hong Kong stock market, and I think there's a third one, and you combine them in size, it should be about 20-25% of the MSCI World Index. It should be, but it's only about 2 or 3 or 4% of that index. And my view was that over time, Chinese companies would become more and more accepted in the world, and more investors would come in, and I wanted to be there, right? Since then, things have changed, and our position has changed, and I'm not ashamed to say that. The COVID lockdown in China was harsher than the rest of the world, and we expected the rebound. That never happened. So the question is China investable, and what are the issues, right? There's the Taiwan risk hanging over our heads, which is the Chinese policy is Taiwan belongs to China, and there's no solution to this, but it is hanging over our heads. We have deteriorating relationships between China and the US. There's been a few attempts by the Biden administration to fix that, but if Trump comes back next year, you can expect worsening relations with China. We all remember some of Trump's comments about China. Policy unpredictability. This is a more significant reason for me, because it means the Chinese government is interfering in the economy, in the companies, particularly the companies. They have this anti-very large company stance, and they want to limit the company. The Chinese government is threatened by these very large companies, so they want to limit them, and they've interfered in a number of major listings, and this is too difficult for us. And there's also the background fear that China will become like Japan. For 20 years, Japan's stock market never moved anywhere, and it didn't go near to its peak from the 80s. And the bottom line is that the risks are too high, and the reward for now is not there. So we've exited China, and we wait for better days. I think it'll be a long time before China becomes investable by the West. Okay, let's talk about Israel. As I said, these points are from Professor Flug's presentation. The Israeli economy was very strong heading into the war, okay? A lot of people, especially the English-speaking, in fact, everybody underestimates just how strong the Israeli economy is. We had better GDP growth each year over the last 10 years than European area and OECD countries. We had our lowest unemployment ever and our highest labor participation ever, okay, leading into the war. We had inflation that was consistently lower than America and the Euro area and the OECD countries. We had rapid and strong recoveries from the 2008 crisis and from the COVID crisis. We got a strong, innovative tech sector. We got strong, stable financial institutions that are well capitalized and have got strict lending policies. We've had rapid recovery from other major security incidents. Okay, granted, this one is bigger, but we've had rapid recovery in the past. And all of this led to the shekel being the strongest currency in the world post 2008. And I think all the immigrants to Israel who are on this call will know very well the pain of a strong shekel. We need to make an assumption. If you look about the Israeli economy, you have to make an assumption about the war, and the war is not over. It could become a lot worse. I'm going to assume that it's not going to become worse. If it does, then we'll have to deal with that at the time. I expect a repeat of what happened at the beginning of this war, right? Which is a sharp sell-off in corporate bonds and Tel Aviv stock market, and a rapid weakening of the shekel. If something major happens in February. If we get through February, then I think that would be a good sign. The damage to the Israeli economy is very geographic and sector specific. So hotels, those hotels who haven't leased out to the government, food services and construction are going to feel the pain more. There's a huge delays in construction projects because of the lack of access to workers. And that's where there's going to be some pain. I do expect a strong recovery after the war. After the war in inverted commas, because we don't know exactly when after the war is going to be. But we do expect Israel to bounce back because of its strong fundamentals as soon as we can declare the war over. Okay. The Tel Aviv stock market is already, and it was a few weeks ago, it was already back at its pre-war levels. Okay. But its performance is lagging. The Tel Aviv stock market has got some issues, mainly liquidity, too few companies for the size of the economy, and issues like that. But it has already bounced back from this war, October war. Credit card purchases dropped unbelievably sharply in October and half of November, and then back into November, December, they also recovered back to their pre-war levels. The drop in spending in October was worse than any lockdown during COVID on the credit card purchases side. GDP growth per capita is expected to be flat or nothing or negligible, so which I think is a good result given the scale of this war. An upturn in spending and a downturn in revenue means the government's going to have a deficit. That deficit is not it's not the end of the world. That deficit comes through in debt to GDP. So that in order to finance the deficit, the Israeli government has to borrow more money from the market, which it can do. And the level of debt to GDP is expected to be at the end of 2024, on the assumption that we don't have a full-on war with Hezbollah. It's supposed to be somewhere between 65 and 68%. Assume that if we have a worse war, then it'll be 70, 72, maybe even 74% of GDP. Those are not numbers which should scare the public market, the investing market, okay? The world post-COVID got used to much higher levels of debt across the world, and 65 to 72% is not something which makes Israel a high-risk country. So I think that should give us some comfort on there. And just looking at the budget deficit side, what I like about this graph is you can see the orange column on the right is the expected budget deficit in percentages, and you can see that it's less than COVID. So the COVID budget deficit was double what we currently have, we're currently expecting. Obviously, again, if the war gets worse, then that number will be higher, but we've still got a long way to go till it's at the COVID levels. And that should give us some comfort that even if even if we have this worse war and budget deficit, etc., Israeli economy should be able to absorb it. Okay. As I said, the war is not over, and duration and intensity of the war will determine the economic blow. So it's very difficult at this point to make an investment decision. Within our portfolios, we're more conservatively positioned than we would be. Lots of quality bonds. We got some government bonds, good company bonds, and I'm very happy with that. And again, historically, the economy has shown strong resilience to global and defense-related shocks. So we've had some wobbles before in the past and bounced back nicely. Government policy is important, and we need some responsible government. And maybe that is our real problem. And I certainly hope that the government prioritizes its budget for war and war-related needs and completely reduces other types of spending. So this is the war after the war, right? I have no doubt that the government is going to fight over where the money goes, but I do hope that they're sensible and they realize that the war issues take priority over all other government issues. In the back of the mind, what's the risk? The risk is that the government misbehaves or is irresponsible to the point that the investing world, that the markets lose faith in and lose confidence in the Israeli government or the Israeli economy, and that would be bad. Okay, briefly, my crystal ball for 2024. On condition that there's no worsening of the geopolitical landscape, I expect relative rate stability. So that means the 10-year reference line should bounce between 3.8 and 4.5 maybe, 4.6 even. And we can collect our coupons. That's a normal amount of bond volatility. I can handle that. I mean, we all can handle that. You'll barely notice that in your portfolios. And this is fantastic for conservative investors. Okay, it really is. On the equity side, I am cautiously optimistic. I think the equity market will be positive in 2023, but 2024, but not nearly as positive as 2023. I don't expect another 27% unless the AI theme just runs completely wild, and then we'll have to be cautious. So I do expect a positive return. Remember, in equities, our expected return is only about 7%, right? And if historically we've been getting about 10 from the US, but anything above 7 is great. Anything below 7 is disappointing. So I reasonably positive for equities and reasonably positive for other risk assets. Alternative, if this assumption is correct, then the alternative asset class should deliver its expected returns without any crazy stories. And that's my crystal ball. Hope that works out. All right. I hope you like my picture on the left here. Some questions which received on registration. With the world geopolitical situation so unstable and unexpected, should we sell everything? Absolutely not. That, in my opinion, would be a mistake. You can position, if you're worried and you're feeling less of a risk appetite, you can build a conservative portfolio, but I would not sell everything. If you remember my discussion about the fixed deposit from banks, we expect those rates to come down. I don't think you can renew a fixed deposit already now. I don't think you can get the rates that you can get that you would have got 6 months ago. So those fixed deposit rates are coming down. Yes, you won't have any market risk, but I expect to do better in a balanced portfolio over time than a fixed deposit. And if you're worried, speak to your advisor and position your portfolio conservatively. But no, do not sell everything. Next question. Do you think a wider international diversification away from Israeli assets should be considered? On the assumption that the war will end and there will be a rebound after the war, I would not be exiting Israel completely. Obviously, person needs to look at their overall wealth and their exposure, what percent of their assets are global, what percentage of their assets are local, what percentage is shekels, dollars, etc. So that's a kind of individual question, but on a whole, I would not be running away from Israel. Israel's got some solid fundamentals, and you know, we should be able to enjoy that. The next question is about currency. I think I got it in 4 or 5 different variations in the registration questions. Lots of people thinking about currency, but currency is the hardest one to predict, okay? Remember, with currency, there's always 2 sides. There's always, so for example, the dollar shekel, there's going to be there's things that are going to happen on the dollar side that can influence. So even if everything in Israel stays the exact same, you can still have movement on that currency rate. So it's at both sides. Now, the US, okay, the scarier the world is, right, the more demand there is for dollars. The US dollar is still the world's strongest currency. It's still regarded as the reserve currency of the world. There's no second place. The euro is, I don't think, will ever be, and the Chinese currency. So there's no second place, okay? Those of you who like Bitcoin and things like that, good luck to you. The dollar, when the world is scary, money flows to the dollar. That makes the dollar stronger, right? And if the dollar is stronger, then the shekel could be weaker. But on the other hand, all the fundamentals of the shekel are very, very strong. So if the war ends, please God, the war will end, and the economy will come back, I believe the shekel will strengthen. I don't think we'll see 310 or 308, I think was the strongest point. I don't think we'll see that number anytime soon, but I think the rate today is 371, I checked. And so expect a range, in my opinion, from 3.5 to 3.8, depending on what happens. So plenty of room for it to strengthen. I don't think it's going to go under 3.5 anytime soon, but within that range. And again, predicting currencies is extremely difficult to do, but I do think we're going to stay in that range. If the war gets worse, then it'll shoot out to 4. From a planning point of view, all the immigrants to Israel on this call, you need to use the exchange rate in your advantage. You need to move dollars to shekels. You're living here, your expenses are here, and you need to move dollars to shekels and take advantage of these weaker rates, because I do believe the shekel is stronger. If the world calms down and there's less of this global geopolitical risk, then the dollar loses some of its appeal, okay? And the shekel will strengthen. So we might see a pretty rapid strengthening to 3.5, 3.4. So you need to use these weaker rates to your advantage. It's a similar story on the sterling side, except the UK sterling is not one of the reserve currencies of the world. It's a strong economy, but it's not regarded. So there's more volatility on the sterling side, makes it harder to predict. But again, I think the strongest rate to the pound, I believe, was 3.7. We're now somewhere around 4.7. And at one point, I think we came close to 5. So again, I think it'll stay somewhere in the middle. It won't go all the way back down to 3.7. And on the other hand, unless something terrible happens, it won't go back to 5. So anywhere between 4.5 and 4.8. Okay, so you speak to the risk of investing in the Israeli market now. So putting money now, for me, in the Israeli market, we like some of the Israeli bonds, some of the quality bonds. There's a premium over cash rates there that we like. They're not as long as the dollar bonds that we buy. And that's just a function of what's available in the market. The Tel Aviv Stock Exchange, it's not a great stock exchange, to be honest, and in our equity part of our shekel portfolios, we're mostly invested in global stock, global stuff hedged back to shekels. So you're taking a view on, if you invest in Israeli equities, then you're taking a view on the war right now, which is an extremely difficult thing to do. Real estate in Israel. Professor Flug said there's a massive shortage. She put the numbers up. There's a massive shortage of apartments in Israel. They can't build fast enough, and that shortage is always there. In addition, there are not many forced sellers in Israel. It's not an over-levered. The bank lending is very strict on what mortgages you can get. And it's unlikely that we're going to see a dive in property prices. You might see a softening, you might see a slowing down number of deals, but I don't think you're going to see a massive drop. You might, in the expensive houses, they're definitely going to have bigger swings than in your average apartment. So the fundamentals of the Israeli property market have not changed. There's still a massive shortage of apartments. It's hard to imagine, the prices are high. It's hard to imagine people affording these apartments. And so that's my view. I don't think there's much upside, but I also don't think there's much downside. Rental yields are not interesting compared to bond yields. For many years, rental yields were higher than bond yields, but we're now the opposite. Bond yields are higher than rental yields. Can I make money on a conservative investment mandate? Yes, finally. Post 2022, I believe that, I believe that interest will stay higher than they were, not as high as in the past, but we can still earn a reasonable amount in a dollar portfolio. If you're 100% bonds in the most conservative stuff, you can still get a gross yield of about 5% without too much effort. And on the shekel side, similar, a little lower, but not too much lower. What about investing in AI? So we don't specifically invest in AI as a theme. It's one of these broad themes that are like the internet that are affecting companies. We're enjoying the AI theme via our exposure to the broad indices, but we're not investing specifically in the AI theme. We need to watch out for bubbles, not yet, but it's one of those things. I'm really worried that AI is going to run and, it's going to overcook. It's one of those things that are probably going to overcook. How will international stock markets react to Trump winning the November election? I don't know. I don't think it's a foregone conclusion that he's going to win. He certainly looks like he's likely to win. And I think that's more of a reflection of a poor Democrat contender rather than a Trump strength. But I don't know. The last time he came in, the stock market went ballistic. It was extremely positive for the stock market. So if I have to guess, I would say it will be positive, but one never knows. What is the recommended positioning and strategy for a low, medium risk tolerant investor? Well, this hasn't changed much. It's different for a shekel portfolio and a global portfolio. A global portfolio, the traditional American balanced portfolio is 50% equities, 50% stocks. Outside of America, people are more conservative, so they don't go for a full 50%. So a balanced portfolio, or a medium risk portfolio would be 40% equities. I'm completely comfortable with that for a medium risk portfolio. And a lower risk will have less equities and more bonds. And there you can expect a reasonable return, not like the period of 2010 to 2020. Okay, so those are the questions that I picked out from the registration process. And I chose questions which were more general that other people can benefit. There were a couple of questions which were very, very specific on specific stocks and stuff like that. I don't think that's relevant for everyone, so I ignored those. Let's see. Is North Korea a political risk for 2024? Absolutely. Absolutely it is. I don't know. The only one who's managed to contain that is Trump. He threatened them, and I don't know. I don't know what will be, but yes, it's definitely something that could go sideways. Will we include crypto index as part of your portfolios? Absolutely not. We will not invest in cryptos. If we have a request from a client and the client wants exposure, then we will buy one of these ETFs that track the Bitcoin or whatever. Even though they're not perfect, there is a bit of a tracking error there. But we don't nearly have enough conviction in that space to include it in our model portfolios. Okay, I think I've hit all the questions. I'm 52 minutes, which is a little bit over the 45 minutes that I hope for. So I hope that you've enjoyed this. It's a recording will be available on our website in a couple of days. If you have any other questions, feel free to contact us. Thank you. Stay safe. I hope that all of you on this call, I hope your families, those of you with soldiers serving in your family, I pray for their safe return. Thank you very much. Good evening.